Now let's move on to another inventory cost method, the first in, first out. That means that when we purchase the inventory first, we assume that that inventory first sold out. Okay, so for example, in this case, the beginning inventory, the 10 units at $10 per unit, if we sold some of our total inventory out of 60, we measure the cost of goods sold from this beginning inventory, and then next, and then next. Okay, then we'll apply this procedure into this practice. The same transaction, but different inventory cost recognition. Now, the March 1st, we purchased number one. The beginning inventory we already have. Okay, is the ending inventory of the last year is converted into the beginning inventory. So we don't have transaction this year related to this, but we started from this beginning inventory, $100 total cost. Okay, so the March 1st, how do you record? Right, the inventory, the same. Okay, I just want to start the inventory and cash out. How much? The same procedure. And then the inventory 450 and cash out when we purchase this 450. Okay, then October 1st, we sold the inventory 40 units at $25 per unit. So the sales and the cash in. How do you record this? Sales amount. Okay, 25, again the same, $25 per unit times 40 units. Then cash in. Then based on the matching principle, we should record the cost of goods sold, right? The COGS, or just okay, the cost of goods sold. Then inventory out. How much the inventory the goods sold? How much is the cost of inventory? In that case, the 40 units we measure starting from the beginning, and then next, so total 35, and then the rest amount is 5 out of 40, right? So we apply, let me calculate in this way, there's 10 times 10 units, so 10 units, or you can just multiple in this way, $25 per unit times $14 per unit. Total number of units sold was 40 units October 1st, right? So now out of 25 last purchased, 5 now times $18 per unit. Is that correct? So the cost of goods sold is now 540. That is the inventory cost out. Again, based on the first in, first out method, we start counting the beginning inventory because it is first in, and then the first purchased, the 25, and then out of 25, 5. So 5 times $18, okay? So we measure the cost of goods sold and the inventory out, 550. Then how do you calculate the tax expense? Tax expense, once again, the sales minus cost of goods sold, which is the gross profit, or the income before tax if there's no other transaction after that, then times 40%. So 184 is the tax amount, and then cash out by this payment. Then let's record it. Let's post this journal entry into the balance sheet and income statement the first year. Inventory up 35, and then cash out 350, and then inventory increased by 450 and cash out 450, the same amount. We still matched out 1,000 between total asset and liability and equity. Now, the sales we made 1,000 by selling 40 units, and then cost of goods sold, we should record this. Oh, before this, let's go one by one. When we sell 1,000, then we increase this cash, right? And then cost of goods sold is 540. So we got the gross profit 460. By 540, we reduce this inventory out by this amount, 540. And then we record income before tax. We don't have other transaction on that year. And then tax expense minus 184, and then the net income is 276. Should be recorded on the retained earning as well, right? So we got 127. Oh, we missed cash out here, 184. So we balanced out first year. Now the second year, we sold all the rest of the inventory. 20 units, because we sold our 40 units the year 1, October 1st. Out of 60, the remaining is 20 units. So the 20 units, how to record? The same. I'm going to just use this, the same name of account, cash, and then the sales. But here, the sales, how do you calculate the sales? Now, the 20 units times 25 per $25 per unit at the selling price. So $500 is the cash in. Now, based on the matching principle, cost of goods sold, we want to record what is the inventory cost. Okay, it is just the 360, but in order to make sure that this inventory or cost of goods sold was 20 units, the remaining is not this inventory 10, not from this inventory 25, but the last purchase, because we record the first in, first out. So we sold this 10 inventory, 25 inventory, and 5 inventory out of the last purchase. So remaining is the inventory, the last purchased, right? So this inventory. So we calculate 20 times $18. So 360, which is the ending inventory of the last year. So cost of goods sold is the same. Then how do you record the tax expense on December 31st, the tax paid and the cash out? How do you calculate it? In the same way, the sales minus the cost of goods sold, which is the gross profit. If you don't have any other transaction, that is income before tax, times 40%. So $58. So cash out $58. Okay, then let's post this journal entry into the balance sheet. Okay, as we practiced earlier, all the balance sheet account of the last year is the beginning balance of the current year. So we should start from then on by just starting from the ending inventory of last year as a beginning inventory. But the income statement is the 1 year transaction, you need to remember. Okay, so the cash, now cash in by selling the product, the remaining inventory 500, and then sales up 500. Cost of goods sold 360, and then inventory out by 360 because we sold every inventory, so we don't have any inventory at the end of the year, December 31st. The gross profit of the second year is sales minus cost of goods sold, and then there's no other transaction, so 140 is the income before tax. And then tax expense, we recorded 56, and then net income is 84. The cash out when we pay the tax expense is 56. And then this retained earning should add this the net income of the second year. So the retained earning 360. As you can see that in the previous case of this, the average cost method 360 is the same. Okay, but it shows the different procedure, the same procedure, but the different amount of the inventory of the first year and the cost of goods sold, and the second year the cost of goods sold. Okay, in the average cost method, you see the ending inventory was 300, but here ending inventory is 360. Why the ending inventory is expensive? Because we count the cheapest the inventory sold out first, right? So the remaining inventory at the end of the first year is the expensive one, right? So that's why the inventory is the expensive at the end of year. But the cost of goods sold compared with this cost of goods sold average inventory 600 is now the cost of goods sold under the FIFO is cheap. Why? Because we count cost of goods sold from the first inventory purchased, which is the cheapest one, right? That's why. But the second year cost of goods sold is 360 from this ending inventory, the remaining inventory, which is the expensive one, right? So 360 turns to the cost of goods sold the next year, assuming that we sold every rest of this inventory. That also affects the tax amount. 184 average 160. We pay a more tax based on the first in first out the inventory. Why? Because the cost of goods sold is cheapest one, so that we measure the gross profit high. The income tax is calculated based on the income made by this sales minus cost of goods sold. So we pay more tax first year, but the second year, you see the second year, the company pays less amount. Why? The cost of goods sold is now the expensive one, so the gross profit gets lower. Okay, so in the next video clip, we'll practice the last in, first out. See you in the next video clip. Bye bye.